Hi there. If you're looking for an investment property in Toronto, you've come to the right place. We have a brand new listing that just hit the market, and I just want to take a moment and go over the numbers with you. Come along, let's take a look. This property is located in Toronto in East York. It's got 3 stories and it's got 12 units in it. You have an asking price of $5.399 million. Based on the income that the property generates, we believe that this property would qualify for $3.99 million, so almost $4 million in mortgage, and the rate would be around 4.5%, which means that your monthly mortgage payment will be around $20,246. For the purpose of this analysis, we ran the numbers based on a 10-year term and a 10-year hold period for you. If you hold it for longer, obviously you would make more money. For this one, we're just going to do 10-year term. All right, so you got one bachelor in there. The bachelor is currently charging $2,050.88. The market rent for a bachelor in the area is around $2,100. There's four 2 bedrooms, one washroom. These are unrenovated units in the building, currently paying $1,227.33. Market rent for such units is around $3,600. And then you have 7 2 bedrooms, 3 washrooms. Basically, what these are renovated units where the owner has went in and divided the 2 bedroom unit up into 3 units. I can talk more about it if you're interested. You can have a conversation with me. They're currently charging $36.22. We expect that you should be able to get $4,000, if not $4,200 for these units. And then you have laundry income for about $240 a month. So total monthly works out to $32,544, or the average per unit is around $27.12. Take out the vacancy of 352 times 12, it works out to 398,216. Now, this number, if you were doing the math along with me, would be a little bit higher because this is projecting what the rent is going to be at the end of year one. So by that time, you're going to have a rent increase of 2%, and you're also going to have turnover. There's one unit that is actually becoming vacant soon. You can convert that into 3 units if you like. Your rent at the minimum would be around 398,000. Expenses are at 97,486, and how we calculated that, we put 4% management fee, which works out to 15,928. $6,600 for personnel. There is a gentleman that takes care of the property and does the odd end things here and there. Doesn't cost $6,600, but we have that as a placeholder. $2,400 for G&A, marketing at $600, repair and maintenance at $850 a unit. It's at $10,200. Utilities come out to $33,240. Property taxes actual $21,552. Insurance actual $5,700. Actually, their insurance is a little bit cheaper, but $5,700. And capital reserves at $720. Total expense comes out to $97,099. Because we're projecting it over the next year, we inflate the number, so it comes out to $94,486. Net income $300,000, $730. Your mortgage payment, which we calculated above, $242,000, which means cash flow for year one is $57,765. Add your principal recapture because you're going to be paying down your mortgage after the first year. It total comes out to $122,232. There are closing costs associated with this. Land transfer tax for Ontario, $121,000. Toronto land transfer tax, $104,000. Lawyer fees are around $3,500, and you're also going to have environmental, which is around $3,500. Total closing costs required would be $232,944. Total cash requirement for this deal would be $1.636 million. I'm going to take it behind the scene and just show you a little bit more detail about the numbers and how we came up with the mortgage. We basically took the purchase price, added it here, and then based on the income, you're generating a DSCR. DSCR stands for debt service coverage ratio. Banks are looking for around 1.2x for a property like this. Now, this number changes. If the rate you're getting is 4.25, your debt coverage ratio is 1.24. If your rate is 4.75, your debt coverage ratio is 1.16. So we based it at 4.5. With 30-year amortization, you will be able to get a 74% loan to value with a loan amount of 3.995. This represents a cap rate of 5.57% with a closing cost of $232,000, as we mentioned before. Looking at the revenue side, so you have bachelors currently renting for $2,051. Market rent is $2,100, so there's a $49 gap to market on this unit. On the 4 units that are not renovated, you have a gap to market of about $2,375. You have one of the units over here becoming available, so you can actually renovate and take it to market. And on the renovated units, you have a gap to market of about $373. That's based on 3622 that you're getting right now. Here's what the rent roll looks like. So this is the rent roll that you're seeing for the 12 units. There's actually individual leases in the middle that are accumulated together to generate this rent roll. So the total rent roll for the year as of this year is $387,770. On the expenses equation, these are the actual expenses from the vendor. So you have G&A at 3226, repair and maintenance 7167, their utilities $33,241, property taxes 21,552, and insurance is 5686. They didn't have any capital reserve. The property is self-managed, and they don't have any personnel expense. So those are all zero. So the actual expenses for the property are 70,973. We wrote it as somebody who's buying it. They're probably going to have somebody who's going to be doing the property management. So there's 1327 per unit. There's personnel at 660, $200 for G&A, and then we put $50 for marketing, $850 for repair and maintenance. Utilities, same as the actual. Property taxes is actual. And the insurance number, we just bumped it up a little bit to 5,700, and we put a little reserve in here for our appliances. Total expenses we projected is $97,001. So if I was to extrapolate this all and convert it into a 10-year projection, your rents are starting around $395,000 after your vacancy, and we're projecting that they will increase all the way up to $627,000. Your effective, add the laundry amount in there, you're looking at $632,000 or $398,000 for year one. These expenses are the stabilized expenses. So if you put those together, we're expecting that the expenses will go from $97,486 all the way to $121,000, with the net operating income increasing by almost $207,000 over the next 10 years. Your mortgage pay down, you can see the mortgage pay down over the next 10 years. Your cash flow after your debt service starts from $60,000 and goes all the way to $265,000. This is your cash flow that your property is going to be generating, and we expect that this property will be worth around $8.6 million in year 10. Again, these are projections based on our numbers. If you want me to run numbers based on your assumptions, happy to run those numbers. As I said, property is just listed on the market, 12 units. It's got 26 leases in total. Love to chat with you and have a conversation. Reach out, 877-439-2339, Addy at heyaddy.com. Take care, and we'll talk to you soon.